Accounting records. Accounting records, balance sheet P&L, cash flow statements, journal entries, bank statements. These are accounting entries. Invoice, purchase invoice, sales invoice, employees, what we made the payments. Oh, sorry, salary slips. These are accounting entries. Records of initial accounting entries, and supporting records. Accounting entries, which is supporting entries. Sales na sales invoice, purchase na purchase invoice, salary na salary slip. Such as checks and records for electronic fund transfer or bank statements for transfer bank checks, invoices, contracts for making some supply, making some sales or making some purchase in one construction. Now you have a contract, you made some agreement to buy something. Agreement is the records. General subsidiary ledgers, journal entries, and other adjustment to the financial statements that are not reflecting in journal entries. Adjustment to financial statements that are not reflecting in the journal entries. What are the adjustment that can be made? Likewise, sometimes some liability can be current liability, some liability can be non-current liability. Example, you have a bank loan, but the bank loan is a term loan you got, and on the fourth year ending, you'll make the long-term capital gain, like capital loan, long-term outstanding to short-term outstanding. Like current liability, it'll come to current liability. It's not a long-term liability. Then after you have the deposits which you made, that will be for 5 years, 6 years you are made, but this year going to mature. Then what you will do? The maturity time is within the 1 year. It is less than 365 days. So it becomes current asset. So these all which is not reflecting journal entries, but it will reflect in the financial statements. So that's thing. And the records, such as worksheets and spreadsheets supporting the cost location and computation and reconciliation disclosures. These all things.